Hey everyone, welcome back to another episode of the Modern Nonprofit Podcast. I'm your host, Tosha Anderson. I'm flying solo today. I'm talking about a topic that I'm really passionate about, and I've really uncovered some major red flags that new nonprofit CEOs realize after the fact, after they take a new position, after they were sold the dream of the organization that they want to be serving going forward. And it wasn't necessarily out of ill intent. It wasn't to try to be secretive. Oftentimes, these CEOs step into roles realizing that perhaps the staff or the board did not really realize the situation that they were in when they were kind of coming on board and being offered that position. And it's been through that time, in my experience, working with hundreds, if not thousands, of new CEOs of nonprofits now at this point in my career, that we have seen firsthand some of those big surprises that CEOs wish they would have asked more questions about before accepting that job, or at least been able to uncover pretty quickly and early on in their a new time with an organization so that they can put some plans in place to overcome it. Now, like I said, we have recently had a full webinar with much more details and tools available that will link here in the episode. If you want to check out the full webinar, it's totally free. You can register and check that on our website at thecharitycfo.com. Under our resource tab, you can see that webinar and all past webinars, but we'll go ahead and put that in the show notes for anybody looking for more insight. So I thought I could do a little bit of an abbreviated version here, though, just to kind of share that message because it was such a well-received message. I've had numerous messages since then for new CEOs really feeling validated by the conversations and really people asking more insights and tips for things that they could be looking out for early on in their process. So the reality is, if we shared in the webinar, that new CEOs inherit more than a mission. They inherit a lot of risk for the unknown. And I always feel like when I'm working with new CEOs, especially if it's a new client of ours, we're in this journey together. We're kind of lifting up the rocks. And every day it's kind of uncovering more and more and more. And a lot of times these are issues that maybe at face value are very clear that they're financial, and some issues are not financial. But as the accountant in the room, as I often share, I feel like all issues become financial one way or another, but they're not always visible right away, right? Some of these things are often buried in people. Is the team, are they the right people in the right seats, for example? Are they processes or lack thereof processes? Or is it merely just silence? No one's talking about it, or maybe nobody's even aware of it. And I really feel like that first 90 days can really set the tone for the rest of your future or your tenure with that organization. And we're going to talk a little bit more about how we can make those count. So let's dive right into it. 5 things to ask for immediately. Okay, if you are a new CEO, you've recently taken that position and you're wondering, where do I even get started, right? Or you're anticipating taking a new job and you're putting together your first, 6-month plan. What does the first year look like? I know a lot of boards will ask for that if you're entertaining this offer. So I'm going to go over the first 5 things that I'm going to be asking for immediately for the benefit of my new CEO clients as it relates to the financial work within an organization. Number 1, ask for a budget and the assumptions that go into the budget. Okay, as we're talking about the budget, you want to ask questions around how did the budget come to be? When was the budget last approved? Who created it? Was it a collaborative effort? Was it reviewed by a finance committee? Was it shared with the board? Was there good discussion around it? Are there any reservations about some of the assumptions that went into it? More specifically, and especially the assumptions around fundraising. As a CEO, you are ultimately responsible for the revenue generation of that nonprofit. So you need to be understanding, is this fundraising goal actually reasonable? Is it attainable in any way? Has the organization demonstrated a level of success in meeting their fundraising goals? And what assumptions are put in place? How did we actually come up with that number? Are there actually identified donors that are in that gift table or that fundraising plan? Is it a huge go get, as we call it? So unknown sources of those funds. Is it simply just, oh, we're going to increase 10% over what we did last year? Or worst case scenario, is it just a plug number, right? We have all of these expenses that we know that we have to come up with, and we need to balance the budget because that's the culture and that's what we have to do to make our board happy. So we're just going to plug that number. We've got 1.5 million of expenses. So by default, we're going to put 1.5 million in there for revenue because it has to balance to zero, right? With no actual plan on how we're going to achieve that. So that's number 1. Ask for the budget, ask for the assumptions, and ask lots of questions about who, what, when, where, why. How did this budget come to be? The next thing I'm going to be asking for is a copy of the most recent audit and 990. So your organization may not have an audit, but is there anything that resembles something like an audit? For example, is there an annual review done instead, which is, as I like to describe, a little baby audit, not as exhaustive of a process, but still informative? Or is there any other sort of compliance deliverable that your organization might be getting? Maybe it's agreed upon procedures or review of internal controls. Is it any sort of funder audits? If your organization does not participate in a formal audit conducted by a CPA firm, maybe they're getting site visits or reviews from the state grants or funders or city funders. If there are any sort of compliance documents like that, you're going to want to ask for the last 2 years. Specifically, if you get a financial statement audit, you're going to be paying attention to certain language that's going to be in the audit. So when you get that audit report, you're going to see this first several pages are going to be lots of numbers, lots of numbers. You're going to have more or less a balance sheet and a profit and loss. You're going to show the assets, liabilities on the first page. The second page is going to show you the sources of all your revenue and how you spent all of those resources, right, on your expenses, right? And then you're going to go into a statement of cash flows, maybe a statement of functional expenses, and that's going to show you which programs or which departments, used a lot of those resources. But where the really informative things is actually the words behind the numbers. So in the last several pages, we call it the footnotes to the financial statements. And that's more of a narrative form. And a lot of those are going to be very standard boilerplate. It's kind of best practices on certain specific required disclosures. They call them footnote disclosures. But some of them are not so standard. And the things that you're going to be looking for are going to be any sort of conversation around going concern language. So a going concern suggests that your organization will not continue operating beyond 12 months, right? So you're going to be paying attention to that. If there's any sort of management plan in there around how are you going to continue operating, maybe that's a step before you get to going concern, but all signs are pointing to this is not such a great trend that we're on. If you're going to see issues around unresolved findings, so if there's going to be a bunch of comments around internal control issues or significant deficiencies in the financial statements, if there's a lot of adjustments, it might suggest that your accounting team is not as well equipped to do the accounting for your organization. And also, interestingly, look at the audit opinion, which is usually the very first document right after you get past the cover page and the table of contents. The auditor opinion, pay attention to when that is dated. For example, if it's a year and a half later after the financial year ended, it really begs the question that there are a lot of delays and understanding why there are delays. Are the delays simply because your accounting team does not have the resources or is experienced enough to prepare for that audit? Was the delays in turnover in staff? Like, what's happening that the audit is so delayed? Now, admittedly, sometimes the auditors are a little bit at fault here, but a lot of times it's a lack of preparation internally that delays those audits. So pay attention to things like the date. Okay, so number one, ask for the budget and the assumptions. Number two, ask for the audit 990. You're not just looking at the content of those reports, but you're looking at the date. Are there significant delays? And is that a red flag that perhaps your accounting function is not operating very effectively? So number three, you're going to be asking about funder reviews, accreditation cycles, and more importantly, any corrective actions. So if you have a handful of funders that make up a significant amount of your revenue, you want to make sure you're in good standing with them, that there are no major issues, that the funders are not saying you have some immediate problems within your programs or your operations that might suggest we may not continue funding you at for a particular period of time. So you want to be asking about those, and not just with your funders, but your accreditation. If you are an organization that gets accredited, typically every few years, are you seeing significant findings as part of that review process? And if there are issues observed, whether it's through funder reviews or your accreditation process or any other sort of compliance monitoring and reporting, you want to know what those corrective actions are. I can't tell you how many times I've worked with nonprofit leaders, did not realize that they had these corrective action plans, or more importantly, that there were exceptions noted in the review or issues raised that perhaps there was a corrective plan and put in place in terms of, hey, this is what we're going to do, but it was never actually executed, or that wasn't actually communicated to the team. So then what happens is you have another year that comes by or another cycle that goes by, and then you have the same issues noted, even though the organization addressed, yeah, we have those problems and we're going to fix them, but they never actually fix them. Not something that we want to be having those conversations with our accrediting body, and especially not our funders, right? So that was number 3. Ask about funders and where you stand with them. Number 4 is just get a copy of the most recent financial reporting package. Okay. And this is going to be pretty telling because let's say that June just ended and the most recent monthly financial reporting package was February. That's a problem. That's a problem because that's suggesting that your accounting function is not operating effectively. It's not closing the books on a timely basis. You just don't have the financial snapshots that you need in order to make informed decisions. You should be asking lots of questions about why you can't get the reports on a timely basis. And it's probably a combination of people and processes, if we're being totally honest with ourselves. But pay attention to once, if you, let's say good, best case scenario, you get a copy of a most recent financial report and there are no major delays. That's best case scenario. Start looking into certain key internal reports like a budget versus actual. Are the real actual numbers that are happening anywhere near the budget? Was that budget reasonable? Where are the key variances? Are we over and under in certain areas? Do we need to have some corrective action with that budget based on what we now know to be true with our current year operations? You want to look at things like cash on hand. How much money do we actually have in the bank? Do we have enough to feel like we can rest a little easy at night, or are we up thinking how we're going to make the next payroll run? These are things that you want to know. If you are an organization that really struggles with having enough cash on hand, you might want to dig a little bit deeper into understanding, what are the cyclical trends within our cash? Like when does the main sources of funds come in? Is it certain points of the year? Is it certain points of the month? And what are the major cash outflows for most organizations? That's going to be payroll. And is there going to be a point where you're going to run out of cash because your inflow does not line up perfectly with your outflow, right? And then another thing that I really encourage our clients, our new CEOs to be paying attention to are restricted grants and what those fund balances are. So if you are an organization that has lots of restricted grants and you have to monitor and manage the spend down of those grants, you want to make sure that you understand what you've committed to and where you're at in that process. And alternatively, if you have a grant that's awarded to you, but it's reimbursement in nature, which means you have to do something, you have to earn it, you have to absorb the cost, and then you submit a reimbursement. I can't tell you how many organizations leave money on the table because they're not paying attention to where they're at in that spend down process. Meaning if you have $100,000 and you've only spent 25,000 and you only have a certain period of time for which you can spend those dollars, if you're not keeping a close eye on what those expenses are and submitting those reimbursements in time, you could very easily have been awarded 100,000 but fall something very short of actual revenue if you're not managing to that. All right, last but not least, pay attention to who's doing the books. Who is operating behind the numbers? Ask lots of questions about whether your accounting is handled in-house or it's outsourced to a firm. What's their experience and tenure, not just within your organization, but maybe as a whole? What is the board level oversight? How has that person been operating in that function? Has it been effective? Has it been ineffective? And again, all of these prior things that I've mentioned can be copies of the reporting package, looking at the auditors, looking at the audit reports rather, looking at the funder reports. Those should all be a pretty clear indication if your accounting function is working effectively or not. So these are definitely things that you want to be asking lots of questions about. Get your hands on it as quickly as possible, and or preferably if you can get your hands on these things before you even accept a position, even better. So just to reiterate, some major red flags that I have seen time and time again with nonprofit clients: delayed reports or reports that just don't align with operations, no follow-up from previous audit findings or issues noted in any sort of compliance reviews, conflicting financial data depending on who you ask. So if your fundraising team is saying you're off track and your accounting team is saying we're way off track, that's probably a problem. If you have no clear owner of who's responsible for compliance or reporting, and nobody really has a sense on where they stand with those major funders or year-end audits or whoever it might be that you owe some sort of compliance to. those are all pretty big red flags. So really it kind of comes down to that's a lot. What do I do with all of it? How do I first get started? So I would say within the first 90 days, really ask yourself or kind of focusing on these next few areas. Clarify roles and responsibility. Take an inventory of who does what. Understand whether it makes sense for someone to be doing these tasks versus those tasks. For example, I've seen so many nonprofits that will have, three different people in accounting and everybody does invoicing, but to different funders. Not because it makes sense for their particular role. It's just like, well, this person started doing invoicing, and then over time we added another person, and then we got a new funding source since that person started. So then they started doing invoicing. Like, should it make sense to really divide and conquer the work in a different way? And making sure that for each key function of your accounting and financial management, that a specific person owns that process. And more importantly, making sure that that process is documented somewhere and that backup to that person knows where to find that documentation of that process. So clarify roles and responsibilities. Do that within your first 90 days. Next, set a regular meeting cadence with your finance team. If you are not sitting down at least on a monthly basis with your CFO, controller, outsource, in-house, doesn't matter. If you're not sitting down on a regular cadence with your finance team, reviewing those monthly reports, checking that budget to actual, paying attention to any other red flags, I think you're missing an opportunity there. The more you can sit down with your financial team within the first 90 days and beyond, I think the better. And then really get a good understanding of what's happening within your organization, reshaping your financial story of your organization, not just what's on those reports, but how you are able to explain to your outside stakeholders, whether it's your funders, your donors, maybe it's even your employees, maybe it's your board members, right? How do you explain what's happening within your organization? What immediate and longer term needs do you have? And what is next for the organization? So ultimately, your job isn't just to be the CEO, but in many ways, it's to be the CFO and the Chief Development Officer and all of the things. You may not necessarily be doing the accounting, but let's be honest, at the end of the day, all eyes are going to be looking at you to make sure that you're accountable for the organization's financial health. And really just asking those questions is going to prevent disasters from happening. Disasters like missing opportunities on funding or not realizing that that fundraising plan only included operational needs and not that big debt balloon payment that's due next year, right? So asking lots of questions is going to help you build trust, not only with your board, but also your funders and especially your team. So those are the things that you can go out and do within your first 90 days. And even just this week, think about reviewing your audit 990, brush that off and check and see if you have any compliance issues there. Meet with your finance team and start understanding who's doing what. And does that really make sense? Or is that just the way we've always done it? And identify one risk area that you want to better understand. That is a recap of this most recent webinar. Go to our website at thecharitycfo.com. Check under the resource tab, check out this full webinar and all of our past webinars for more specific insights. It's been so great having this conversation with you all. I hope you found it insightful. And as you know, my shameless plug, if you found this information helpful or useful in any way, please interact with it in some way. Share it with your colleagues, like it, subscribe, thumbs up, wherever you might be listening to this. Thank you all so much. And see you next time. Bye.